Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, April 6, 2020. It's about 10:30 Eastern time as I'm starting the video, and I wanted to do an update. I figured it's a good time to do an update on the equity markets. We'll do this one a little bit different. Instead of posting the same levels that I post, I'm going to dig a little deeper and look at some of the top components of the Nasdaq 100 and S&P 500. As I always say, if you want to know where the market's going, you really only have to know where the largest stocks in there are going, particularly in the Nasdaq 100. And then I also want to look at some of the sectors in the market. Of course, the S&P 500 is comprised of 11 sectors, and you can track those. There are ETFs for each one. So if you want to know where that's going, then you look at, of course, the largest sectors, and I'll go through those as well. All right, so let's start here with QQQ. What happened today. The futures went up overnight, and we gapped up above the recent trading range. So that's obviously a near-term bullish technical event. But I want to put this move into perspective. We're up 4.5% in the Qs. And remember, 4.5% rallies, if you're interpreting this as any different from a 4.5% drop, it's not the case. And 4.5% rallies only come during bear market, for the most part. Let me just hold that back and say, for the most part, with very, very few exceptions, if any, 4.5%, 5% gains in the market come during bear markets and very powerful corrections. So let's not chalk up. And I say this because it bears repeating. If you're new to trading and investing, that's the nature of this market. That's why you have to use, for swing traders, wider stops and allow for these big moves. So now, what's changed technically? Well, we did gap above the recent trading range. So again, I'm going to say that's bullish as long as it holds. But I'm also going to show you some other levels to watch. 189.69 or 189.70. That's what happened today. Is all morning in pre-market. I showed you earlier. It's not on this chart. This chart is only reflecting regular session trades. We were dancing on that, and that's really. I didn't want to move this. Well, I can move it now. I showed you. No, it was on SPY, a different board. I'm going to move this line down just a little bit now to better reflect the bottom of the gap that it was set right there. You can see that that's really this candle right here, and that's today's low. So now. Keep it very simple. 189.20, we'll call it 189.21. That level is the important support level to watch because if we enter that, we're going to fall back into that gap and then probably backfill it. So that's, and then above you have not a hard line. You have resistance starting to come in around 193.43, and we'll leave the stop as is. I see absolutely no reason to modify the stop or to change anything in the trading plan on this trade. I still think it will most likely work out. And as I say, if it doesn't, it's like any other trade. You move on to the next one. And we're right about a little bit above our entry price. We entered this one here at 189.62. So you're talking 2 points on a 200-point security. That's about 1% underwater. It's par for the course, and that's after hitting the first two targets. All right, so we're going to look at a few other things before I move away from here, because right now we're looking at price levels, and the same chart I showed you this morning on SPY would be which board did we use? This one. I tightened up and revised these lines. I hadn't changed any lines on that QQQ chart since at least last week, but other than the one I just tweaked right now to show you the support level below. On SPY, I did update these this morning, so I think these are the most significant levels, each and every one you see here. Story on SPY this morning in pre-market, we traded all along on top of that 256.44. It's the top of the gap. I'm referring to the gap right there on April 1st gap down. So we're above gap support. Bullish as long as that holds, but although I don't expect much more upside, and I'm going to go over some of the reasons why. Starting with this, you have the PPO trend indicator right here. I use the 9 EMA. The dotted line is back testing the zero line from below. That's telling us the trend at this point in time, despite this pop, is still bearish, and usually or quite often that level will act as support or resistance when tested from above or below. So look for a rejection here if it moves a lot higher, and you have resistance there 263.19. A solid break and 60-minute close above that could only be construed as bullish. However, right now we're kind of smack in between those two levels, and again with the overall trend being bearish right now. So what I want to show you, let's look at a few more things. I want to look at Fibonacci retracement levels. Okay, starting out here, we're looking, we're still on a 30-minute time frame, but these are, I have two fibs, Fibonacci retracements. I have off the highs right here back in February, the all-time high in the SPY, that entire drop, that's measured by this line here. Don't worry about the angle, it's just how I dragged it down. You can see the Fibonacci, key Fibonacci levels here on the left. And then we also had a major reaction high here. This was our first decent tradable rally. You know, we went long that rally with an official trade, and then reversed and shorted, and then went rode most of that short wave down. And that was right here. That kickback rally pretty much ended. It almost had a double top there, but about March 3rd, and then we had a second test of that level right there. Okay, had to pause the video there to take a phone call, but all right. So back to this chart. This is the S&P 500. You can see the SPY going from the highs down to the major low, and then I also put a Fibonacci from this major reaction high back here, as I was saying. And so the levels are here on the left of the chart. You can just make out, and the big ones here. You have the 38.2% fib. Again, that's on the blue line, so that's from this drop. And then you have what this is a fib cluster right here, and that's what you look for on drawing fibs. You look for these major reactions along the way in a trend, and you can add multiple fibs, and you look for those that line up. And I also, by the way, I like to use these in conjunction with price resistance levels as well. But you can see there's two major fib clusters right there, the 38.2 of the entire drop and the 50% fib. That's these two lines just above, and that's also just above where the recent that rally capped here, and then you have the 50 and 61.8, and again this is right now the most important resistance level we're watching, and we're still above that. Now what else does this mean? Well, number one is we're as impressive as this rally has been, it's not overly impressive or really that impressive at all for a bear market rally. It's run of the mill. I know the media spun it real big, saying new bull market, or at least we hit the the 20% rise off the bottom definition of bull market. I was just read an article from the Wall Street Journal about why you don't want to market time in your 401k and retirement accounts, and that for the most part I agree. Long-term stuff. This was active trading stuff down here. I give some upside price targets off the recent lows because it was technically priced into the charts. It was very clear, the recent bullish developments, the excessive put to call ratio, short interest and all that. So a bounce was priced in, and where I'm going, and I'll end it here, is so far this is nothing more than a run-of-the-mill bear market rally. Can it morph into something more? Absolutely. Can we go on, and could this market power to new highs or test the old highs? Anything is possible, but to me extremely unlikely, improbable. Right now, again, by just the fact that we've only retraced these, again, of the entire move, we've fallen shy of that 38.2, and I usually say that's a minimum for, not a minimum, but a typical kickback rally and a counter trend move, I should say. Yeah, kickback rally and a downtrend usually runs between the 38.2 up to the 60% fib retracement. There's the 50 right there, and so far we've fallen shy of that. And again, so if you look from this move there, we've taken out the 32, but we haven't even retraced 50% of the move from here to here. So I just want to put that in perspective. And then look at QQQ. See, I have the similar thing up here somewhere. I have some fibs. Let me find those for you. Okay, here it is. That's it. So there's your high right there. Again, don't, I just moved the line over here. But that line that comes in, starts at the top, the all-time highs in QQQ, down to the lows. Those are the fibs in yellow. And then I also came right here from this major reaction high at that first kickback rally down to the lows. That's in blue. And you can see, you don't even see the numbers because it's almost a perfect overlap right there of the 38.2% key Fibonacci retracement level. And that's off the entire move down. And then from that major reaction high, we have the 50% Fibonacci retracement level, and that's exactly where we're trading right now. And a lot of traders use these fibs, and they do that. They do so because it works. Fibonacci sequence is amazing. If you read about it, you know how often it appears in nature and the financial markets. It's pretty impressive. And again, it's just one thing to look at, but in addition to price resistance and support levels and all that. So as of now, point is, this is nothing more than a bear market rally, and 4 to 5% moves are the new norm lately. We've had many of those in the past few weeks. So as of now, like I said, you got to give a check mark to the bulls because they popped that recent trading range, but they haven't done enough yet to say that this is anything more than just a pop. And by the way, keep in mind too, I should have mentioned that in the post this morning, Sunday night of all nights, Sunday night futures are tend to have the most some of the most extreme moves, and some moves that are very often faded. You don't have the big boys, the institutions step on the playing field at 9:30 a.m. Monday morning. Can they trade futures? Yeah, but it's such a relatively a liquid market that they're not actively trading out there. Plus, the individual stocks aren't trading. So it's only once the market opens, that's when you're going to see if the mutual funds and hedge funds and investors are buying Apple, Amazon, Facebook. And so you tend to get these big moves, and that caused a gap up this morning because the futures went up last night, and undoubtedly probably clearing out a lot of short interest on today's move. So as of now, again, sitting tight on the QQQ short and all the other short trades that we have on the site. All right, now let's look at one other thing, a couple other things actually. Let's look at the sectors here within the S&P 500. Same thing, you have tech, XLK, and I'll go through a little quicker now. You can't even see because it's a perfect overlap right here of the 38.2% fib retracement of the entire move down. Remember, the yellow is going to be at the all-time highs, and then we have at the top of the major reaction item. It looks a little tricky because that's where I put that line right there. See, there's the high, and so there you have the 38.2 and the 50% fibs of those two moves, and that's exactly where XLK has stopped cold today so far. And what I'm doing here is I'm going through the 11 sectors. I won't do them all. We'll hit on the top ones of the S&P 500. This is by far the largest, about a 25% or so weighting last time I checked, and so this is really going to make a big impact on where the market goes. XLV healthcare, they've retraced about, you can see a Fibonacci cluster here, the 50% and 61.8 fib in very close proximity. Also very good price resistance as well right there. And what I'm looking at is this level here. There's there's the fib zone right there, and there's very good price resistance right here. You had a lot of reactions there. When we broke it, we gapped down below. We came up, back tested it, and failed. That made another run towards that level, and here we are again. So you have now the second largest sector of the S&P 500, also with a major Fibonacci cluster plus price resistance as well. XLF, the financials, looks like I didn't put up the fibs. Well, there it is. Yep, I did on another board here. There it is. The 38.2 is where we failed so far, and we're still well below it. The financials are acting very weak, relative to the rest of the stock market and most other sectors. Again, all they've managed they haven't even managed a 38.2% retracement of the entire drop, only the drop off this high right here from that kickback rally. That's where they failed, this blue line here. Over here you have the 38.2 of the entire move down, and then the 50% retracement of the move off this level down to here. So that's XLF. XLC, communication sector, stalling right at the 38 fib. Again, you can't make these levels up. This is all, it's beyond mere coincidence, I think, that you have almost every single sector in the markets right at, these some key Fibonacci retracement levels now. And there's XLY right on the 38.2, again, of the move down off the high from March 3rd. With, by the way, with the, another key cluster above, you can see right there the two Fibonacci's, and that's exactly where it failed as well before. So again, more than just mere coincidence. Too many reactions off these levels. Again, key key levels, the highs, the all-time highs, and then the first kickback rally, exactly where we failed right at that cluster last time. And again, now we're below there. So nothing really overly bullish or anything other than just right now, just noise within a downtrend, a larger downtrend. And I did state a couple, a week or two ago, I said I expected after this whole move up here and this drop that we'd probably chop around over the next couple weeks, and that's what we're doing. And and this is XLI, the industrials, right here at the 38.2 fib again of this move down. And if you look at it just over the last week or so here, we're still, still the makings of a new earlier downtrend, a clear downtrend going into those lows, near-term uptrend, and we've been working our way down, but as I, suspected a week or two ago, more of a choppy, kind of grindy price action than that, the powerful, mostly, unidirectional drop and then unidirectional rally that we had before. And here's XLP. Remember, as I go through these sectors, we're going down in the descending order of weighting in the S&P 500. So they're having a smaller and smaller impact on the overall market when you get to these smaller ones. But this is still an important one, consumer staples. And it's had a pretty healthy, it's recovered 50%. It's right around that 50% retracement of the entire move down off the all-time highs. And with the 61.8 of this move, right here coming up, and rightfully so. I mean, this is what you see during a recession. The stocks that tend to outperform what we're seeing in this bear market rally. Everything got sold down hard in the initial drop because of forced selling, panic selling, liquidation, indexing. Again, I talked about that many times. If you're a component of an index, doesn't matter how good your fundamentals are. When there's heavy selling, the indexes then are meeting withdrawals, money coming out, and they have to sell what they own. So if you're a stock or a sector within the S&P 500, you're probably going to get sold down as well, no matter how good things are going for you at the time as a company. And so, but what happened is, when we got a little stabilization and the chart set up bullish, the buyers have stepped in here and bought the consumer staples, and it shows you this is where the institutions, pension funds, mutual funds that are actively managed, individuals, what they're buying right now. They're buying staples, consumer staples, which again have rallied over 50%, recovered over 50% of their initial drop. When again, remember, tech led the market up. On the way up throughout this entire bull market. It has been the best performing sector, and yet it has only retraced 38.2% retracement off the move of the all-time highs, showing us that that's where although everything has been getting bought up over the last since this low here, I should say. They're buying defensive issues more aggressively, or bidding those up more than they are the high growth sectors like technology. Okay, and finally, now let's just go through, not a lot, just a handful of the top components of the NASDAQ 100 and S&P 500. These are the market-leading stocks. Again, you can go, at least in the NASDAQ 100, you can take these top 5 or 6 stocks, and they're going to have more of an impact than the bottom 40 or 50 stocks combined. That's how heavy weighted these are in the NASDAQ 100. And they're also top components of the S&P 500, although not as heavy. The S&P 500 is a little more balanced out, if you will, but it is still a market cap weighted index. So therefore, the bigger the company, the bigger impact it's going to have on the returns. All right, so we'll look at two things, fibs and price levels. So fibs, Microsoft has, you can see here, I'm just measuring right now off the highs to the lows. Microsoft retraced 50% at that first counter-trend rally, hit the 50% fib, reversed, and we're just a little below it right now. And then price-wise, let's see how Microsoft looks here. Big level. I have a resistance zone, 161.27 to 162.50-ish right there. Very significant price resistance. We failed there before. Reverse, and we're coming back, and we haven't even made a full test of that high. It is still resistance. If we failed there after a brief momentum fueled overshoot, and we're under that resistance again. So look, today's break above the recent trading range, as I said, is can only be chalked up as near-term bullish if you want to look at the near-term stuff, and it could morph into something more. But I will go so far as to say, it offers an objective short entry or add-on here on this bounce, because that's what you do in a bear market. You short the rips and cover the dips, just like opposite of trading in a bull market where you buy the dips and sell the rips. All right, so there's Microsoft, Apple. Right behind it, Apple, you have a pretty important downtrend line coming into play right here. There's downtrend line, and Apple has rallied into that trend line there. We already failed at it once right here recently on that pop up there. We're there again, and we have a very significant level as well. We had a brief momentum field overshoot, so 257.78. So in other words, big resistance right here on Apple. The trend line, and then that 257.80-ish resistance right above. And let's see if I have some fibs up here. Yep, from the all-time highs, Apple has yet to retrace even. Well, it already did it. It popped above the 38.2% fib level there on a brief momentum field overshoot, and we're still below it. So again, it shows you that Apple is, at least on a percentage retracement. The retracement of the move down off the highs, it's lagging a lot of other, some other big companies and sectors out there, especially the defensive sectors. All right, next one up would be Amazon. Amazon, one of the stronger ones. I mentioned that back here recently, that baby got thrown out with the bathwater, and they were positioned better than just about all of their FAANGs because of their unique position. With everybody now staying at home and ordering online, even those people that didn't used to do it. I've always worked from the home, so I'm ordering from Amazon no more or less than I always have. But now a lot of other people who are no longer swinging by on the way home from work, able to run into, wherever it is they need to stop off and pick something up, they're ordering too. So Amazon's been a net beneficiary of that, and as such, you can see it retraced. It failed at the 61.8% fib off the retracement off the all-time high right here. That's the 61.8 fib, and we're still below that level now. We had a bearish rising wedge pattern, complete with divergences. Here, I'll show you. This is really my fib board. This is the price board right here. There was your divergent high, and again, you can see I had the trend line on that other one like this. We had a little wedge like here, broke down, hit the 1890 support. It's a pretty good support level, and bounced. So you can see we are smack between. We're trading in this range right here. Meant to cover the high right there, 1955 we'll call it, and 1890. So we're at resistance right now. That's the point I want to drive home, and coming off that divergent high, by the way. And so when I look at this with a rising wedge, this to me looks like as well positioned as Amazon is. I think this is after the wedge broke down, we had the initial leg down, kickback rally, and I think we'll come on down here and probably come down to that 1815 support again. Alphabet, this is GOOGL, Class A shares. Nice downtrend right here. You can see it's pretty much at the downtrend line right now, give or take, with the 1150 resistance, big level there. So if it can break out, I'm going to give you one more level. If you're targeting, this one has severely lagged behind. Not sure what's going on with Alphabet, but you can see off the highs, it's not even coming, it hasn't even retraced or even come close to the 38.2% retracement yet. So again, I'm not sure fundamentally what's going on with Alphabet. Why, as a tech company, of all companies, again, this is you're thinking, I can't think of a company, one of the big FAANGs, would be any less impacted by coronavirus. Even Apple has retail stores all across the world people walk into, but Alphabet, when was the last time you were in a Google store? I don't know what's going on there, but it is lagging, and it's something to note. Maybe it's going to play a game of catch up. If you want to look for opportunities within the large cap stocks, some of these big names, that one might have more upside, I would think, than some others that have already bounced back quite a bit. And so your buy signal will come if it can solidly take out this trend line in that 1150 level. That would be a target about 1200 right there, and possibly up to 1277. But if the market takes another leg down, it's probably going to bring Alphabet down with it. And Facebook, again, one of the largest in the NASDAQ 100. Nice little, we had the divergent low recently, which was bullish right here, and positive divergence. Set the stage for this rally, which then set up in a bearish rising wedge pattern. Nice, clean, very well-defined trend line. Gap down below it, that was the breakdown, your sell signal right there. Also gap below that 161.45-ish price support level there. Let me make that a little brighter so you can see it. And we went down, little overshoot of this 150-350 support and bounce back. So the story on this one is it broke down from the rising wedge, complete with negative divergence there on the PPO, overbought conditions here on the RSI. First leg down, kickback rally right to resistance. So again, I'm showing the market being, and a lot of these FAANG stocks at resistance right now. Doesn't mean they must go down, but if they're going to reverse, this is a very likely spot, especially being up as much as we are in the market today. So that's a common theme of this video. Most sectors and key stocks in the market at price and or Fibonacci resistance levels. So if they can power up much above today's highs. So look at today's highs in the market, look at today's highs on most of these stocks, and if they take them out by a fair margin, a couple percentage points, that should open the door for a higher move, additional gains. But as of now, I still favor a reversal here and think that today's gains will be faded soon as in probably tomorrow or Wednesday. It's my guess. All right, and a couple more here. Intel looking pretty strong today, up 5%, and this is the 6th largest holding in the NASDAQ 100. You can see the divergence. Remember, we had divergence in place right here at that recent high, and now we extend the divergence right here, potential divergence. So Intel is at resistance right there, about $57 with the divergent high. And let's see if I have some fibs on this one. Just above the 50% fib. Let me move that over there, make sure I have it nice and tight. Yeah, right about on that level now. You can see there, hair above the 50% fib retracement. All right, so that's enough for now. We went through the top sectors and the top holdings in the S&P 500 and NASDAQ 100. And so let's see where the market goes from here. But like I said, I right now I don't see anything in here other than just a, most likely just a bear market rally, one-day rally, I should say, in the market. Probably a lot to do with short covering from the pop. And I think from a fundamental, I was scanning the headlines over the weekend, and what I think drove this thing is they're making all kinds of predictions now that we'll see the peak in a lot of areas in the U.S. here in the next week or two. I hope they're right, and if they're not, that's dangerous for the market to be rallying on these guesses from people that had no idea this thing was coming or was going to get so bad. Those same people, they missed it before, and let's hope that they're right this time on when this thing peaks out. In other words, sooner than later. But God forbid that doesn't prove to be the case, and all those that are buying the rally today because of that are disappointed. It's not going to be ugly, and that'll probably then give us that that next leg down in the bear market. Because remember, bigger picture. Don't forget where we are. This is where we are in a bear market right here. We had a wave one down, a pretty impulsive leg down, followed by a snapback rally, another leg down there. Here, even if, let's just say, you Elliott wavers, and I haven't done the count. That's not my area of expertise, but let's just say this is a 5-wave cycle. Wood mesh here, this is wave 3. Wave 3 is always the most powerful in a primary 5-wave cycle, so that would still tell us that we have a 5th wave down to come. Wave 1, 2, the counter trend wave, wave 3, the most powerful, wave 4, and wave 5 to come. And I would welcome feedback from those of you that do, incorporate Elliott wave theory into your trading, and let me know if the counts, are appropriate. But I've dabbled with it over the years, and I've personally found Elliott wave too subjective to hindsight revisions to make it useful in my trading. It does no good after a big move. Say, oh well, yeah, we can change the wave count now here because of this. So. Anyways, just thought I'd bring that up because when I look at that, it kind of jumps out as a pretty clear, 5-wave cycle with wave 4 recently ending and 5 to come soon. All right, this has been Randy Finney with the right side of the chart. Hope you enjoyed.